JB Cycle is here with an update on August the 21st. So the previous week we reached the full potential of this bear market rally, given the assumption that it is a bear market rally. So we reached the critical horizontal resistance around 4,300 and just below the 200-day moving average and below this trend line, and all this happened at the top of my 4-week cycle. So the question still is my cycle working again? If so, and if this bearish scenario should play out, we should see weakness into the end of August. And then we have another bullish phase of this cycle, and that period has to be sabotaged. So something has to destroy this bullish phase, some bad news or something, making this then a lower shoulder or some kind of a bear flag, and then we should be in a downtrend. So the period in the beginning of September into around September the 10th, we have to look for something sabotaging a bounce or a rally. Let's switch over to this one. So here I have the 7-year cycle in red, and it is suggesting we are in a wave that now has topped out and should bring us down to a lower low around perhaps end of October or early November. So if we start breaking above from here, then something else is going on. Here in the background I have the 6-month shifted S&P, and breaking above that level is something that shouldn't happen at this phase. So let's have a look at bear market rallies. Here is the S&P going back to the 1950s. So well, there's a lot going on in this chart. In red here I have the 7-year cycle, in green that's the 9-month cycle, and in orange that's the distance to the 200-day moving average, or that's the black line here. It's actually the equivalent in the calendar day data. So what we see in bear markets, these bear market rallies typically go up around the 200-day moving average. So here we see it didn't quite get up there. It was missing 1 or 2% up to the 200-day moving average. Here actually we broke above, some 7% above, but that was a fake breakout, and that it's a rare occasion. And then we broke down again. So over here we had a bear market rally, a rather weak one. It didn't get up to the 200-day moving average. Here we have a couple in the 1970s. The first one got up to the moving average, the second one didn't. So we have 1973, 74. This rally got a couple of percent above the moving average. This one didn't get up there. Here we have some small rallies. When I'm looking for bear market rallies, I'm kind of looking for really oversold conditions and then a clear rally. So here we are more rather chopping around below the average. Here we have a bit more oversold conditions and more clear bear market rallies going up around the average. So this one just below and this one got up there. So in the next period we really don't have any real bear market rallies until we get to the year 2000. Here we have bear market rally just below the average, and here a more complex big rally after the 9/11 crash. So we got actually above the average before crashing down again. Then we have 2008, a bear market rally up to the average, and the second one didn't get up there. In 2011 we had something that looked like a bear market rally, but it didn't crash down. It stayed up there and broke up. And here, 2015-16, we had a bear market rally going just above the average before going down, making the final low. Another thing I would like to look at is the 7-year cycle and timing. So here we have a 7-year cycle low, and we see in this cycle the market actually topped out very late. These vertical lines are equivalent to where we are at present day in the cycle. So here in 1953 the market actually topped out right now, or in a couple of weeks time from now in our time equivalent. So this was a very late top, and the low was around the cycle low. Then going forward to the next 7-year cycle, this was also a very late top, kind of a double top, and the final low was at the cycle low. Then we have an unusual case. This was a very early low. Actually, it made its final bear market low around the time where we are right now. So it tried to make a bear market rally, but there was nothing more to bring the market down, so we actually broke up. So this is an exception. So we have the 1975 low at the cycle low. 1980 was a very late top again, and the bear market low was actually a very late low. So a late top and a late low. 1987, also a very late top, and the low was kind of early as well, because it was just a crash, but as we see, the low was later in the cycle than we are right now. And this was a very mild bear market. Actually, you can't define it as a bear market, but it's a cycle low. And you see, we were at some kind of a top at this point in the cycle, and we had another very small downtrend here to make the final low. Then we are over to the 2000. We see the bear market low was at the cycle low, and we go to 2009. That was a bit earlier than the cycle low. 2015, also a bit earlier than the cycle low, but still later than where we are right now. So that brings us here. It would be unusual if the June low was the bear market low. That would be a very, very early low in the cycle. Also, we are at the 200-day moving average, so I'm still assuming we have to head down another time once more. So these are the bear market rallies, or some of them, and we see in black we are at point time-wise where the bear market rallies are over. This one, 2001, was quite unusual. This one in 69, it tried to make it up here, but it needed to get up closer to the 200-day moving average, so it had another wave. And this one was very early, and this one was very early. So removing them, we see this bear market rally length is of a very typical length. So we have to see now. I'm expecting us to go down and establish a downtrend, but if we pull back and make another rally, something else may be going on. See you on the next one.